What to do with an inherited IRA. Hey, what is up? Thanks for stopping by, taking your time to watch this video. I really appreciate it. My name's Keith Wilson. I'm a practicing financial advisor here to help people along their personal finance journey, right? So today, let's talk about inherited IRA. So if you have inherited an IRA, you may be confused of what options you have. Now, first of all, for the purpose of this video, I want to talk about specifically if you are a non-spouse of the person you inherited the IRA from. So, for example, if you inherited an IRA from your parents or your grandparents, that's what I want to talk about. Now, non-spouse beneficiaries have different rules than if you were the spouse. So also, I'm going to be talking about inheriting a traditional IRA, not a Roth IRA, because Roth IRAs, they have different rules to follow. First of all, you got to know tax laws changed in 2020, and if you inherited an IRA in 2020 or beyond, that IRA account, it's got to be liquidated, has to be cashed out within 10 years. Now, actually, I say 10 years, you may have more than 10 years to cash out because the rules say that it must be liquidated 10 years from December 31st of the year the person died. So, for example, if the person died that you inherited the IRA from on, let's say, February 1st, 2021, then the account has to be liquidated by December 31st, 2031. Now, what's the big deal with all this, right? The big deal is that any monies that you pull out of the inherited IRA, it's going to be taxed at your ordinary income tax rate. And this will be added to your already existing income. So let me give you an example. For example, let's say you're married filing jointly and your income is less than roughly $83,000 and you inherit an IRA worth $100,000 and you cash all of it out. That's going to bump your tax bracket up from 12% to 22%. Now, you got to keep in mind that's for 2022 tax brackets, and they're going to change pretty much every year. But anyway, that's a big jump in taxes. So here are a few tips, few strategies when it comes to handling how you withdraw money from the inherited IRA. One idea, simply just spread out the withdrawals each year, paying attention to your tax bracket so it wouldn't cause you to jump to the next tax bracket, right? So perhaps 1/10 of the account value each year is what you pull out. Another thing, if you are self-employed or your income, let's say, is going to vary from year to year, consider taking higher distributions in the years your income is lower and less in years that it is higher. So you see there's no set amount you have to take out each year as long as you drain it by that 10th year. Now, this next strategy is for folks that have, a 401k, 403b, or other company retirement plans. So let's say you make $60,000 a year and you're not maxing out your 401k at work, or hey, maybe you're not even contributing at all. So if, for example, you would contribute $10,000 from your salary to the 401k, then yeah, you're going to be taxed on $50,000, not $60,000. But then turn right around, take a distribution from the inherited IRA of $10,000, and yeah, that's going to be taxed. But what happens is it becomes a wash, and your tax situation, hey, it should be the same. Another strategy, something to consider, is taking the distribution in times when the account has dropped. Perhaps during a market correction And what you do is you reinvest that distribution in a non-retirement investment account. So, for example, let's say the inherited IRA is worth $100,000, but due to, all this market volatility, it's now worth $90,000. You then withdraw, say, $10,000 from that inherited IRA and reinvest that in an investment account. The inherited IRA, what's going to happen, that's going to be worth $80,000 now. And so the idea here is all you do is that it would possibly have less to drain within the 10-year period. And if you are the mindset that after a correction occurs, things could rebound, then that investment account could have the potential advantage of growth. Another idea is if you have an HSA account. Now, an HSA account that's paired with a high deductible health insurance plan. And the contributions are tax deductible, and the money in the HSA grows tax-free as long as they are used for qualified medical expenses. And really what I've found is a lot of people, they don't contribute the maximum amount they can to their HSA. So consider taking the distribution from the inherited IRA, contribute to the HSA account, and what happens is the tax deduction you get on the contribution to your HSA could offset any taxes you would pay from the distribution. So here's the thing, before you just cash out that inherited IRA, consider exploring some of these options first, and really which one is best for you. It depends on your particular situation. So before implementing these strategies, obviously consult your financial professional and your tax advisor first.